Good morning, and thank you for joining our FoodBytes webinar series. My name is Jillian Rago. I'm part of the FoodBytes team, and I'll be your host. Today, our topic is funding future-proof F&A businesses. We'll be hearing from two panelists who will be sharing an inside look at the investing landscape from Q1 to Q3, what successfully fundraising through a pandemic looks like, and what is driving success for startups today. So we'll be kicking off with some introductions and overviews from each of our panelists, followed by some deep diving into panel discussion and ending with 20 minutes of an audience Q&A moderated by our own Nina Myers. This is our 10th webinar in our effort to continue to support and connect our FoodBytes community of startups, corporates, and investors. To date, we've had over 2,000 attendees tune in from 50 different countries, and we have featured speakers that are part of our FoodBytes community all the way from here in New York to the Netherlands to Australia and beyond, really fostering our global reach. And now I'm going to hand it over to my colleague Sonia Shaker, who's going to share a bit of background on the FoodBytes platform and our two programs, Pitch and Pilot. Sonia, over to you.
Thanks, Jillian. A warm welcome to the companies who are joining us for the first time. Through FoodBytes, we aim to connect the most promising entrepreneurs with the food and ag community that we've built and brought together over the past several years. We view these webinars as a perfect example of how our community can build each other up during challenging times and as a natural tie-in to our two distinctive programs. Our FoodBytes Pitch program consists of structured mentor sessions, investor meetings, and corporate introductions, culminating in a live pitch on the final day. This year, we are going 100% virtual, with programming running over the course of 3 weeks from mid-October through early December. Applications are live now through August 10th for interested startups. Our other program, FoodBytes Pilot, pairs a corporate and startup together over 6 to 9 months to collaborate on a specific goal or industry challenge. So if you're an investor or corporate interested in partnership, please reach out to us at foodbytes@rabobank.com. And if you're a startup who would like to learn more, you can reach out to me directly at sonia.shaker@rabobank.com, or you can learn more on our website under the Apply to Pitch section. And with that, I'll hand it back to Jillian.
Fantastic. Thanks, Sonia. I'm really excited that our applications are now open. So again, any startups tuned in, please reach out to us to learn more. So today we're revisiting a topic that continues to be of high interest for our community, which is startup fundraising in this current environment. We're joined by two speakers from our FoodBytes community. First is our member and longtime mentor, Chuck Cotter. Chuck is a partner at Holland Hart, and he is a CPG industry vet who has represented both funds and brands in raising capital, handling acquisitions, and more. So we're really excited to get his perspective on the investing landscape, particularly within the CPG sector today. We're also joined by Poornima Parameswaran of Trace Genomics. Trace is a FoodBytes startup alum, and they have just recently raised through the pandemic. So we'll be getting a real firsthand account of the successes there, the learnings, and really what we're seeing on the ag tech side. And through both of our speakers today, we're going to get kind of this broad range perspective of the food and ag landscape, really from farmer to shelf. So without further ado, I'd like to hand it off to Chuck to set us off. So Chuck, over to you.
Okay, thanks. Thanks for having me. Hi, everyone. So obviously we're talking about fundraising. We're talking about fundraising generally in the food, bev, CPG, food tech, ag tech spaces. I'm going to focus on my personal experience, which is the CPG space. It's sort of by definition still anecdotal rather than statistical, since we don't have statistics out yet for the last 3-4 month period. So speaking from my experience, but why does that experience matter? Well, we usually close between 50 and 80 reasonably sized venture and M&A deals each year in the space. And I'll call it during the pandemic, so I'm starting that clock in early March to now, we've closed 20 deals, and we have some more active. So there really hasn't on the whole been a downtick, but there has been some there have definitely been some learnings to take from it, including that at the start of the pandemic, I would say the general reaction when it came to fundraising from the companies who were close to doing a fundraising, it was, uh, Chuck, we need to get this done now, right? Like, we need to get the money in my bank account. We need to do it before terms change, before everything falls apart. Let's get this done. Not that I'm someone who typically argues over impractical, irrelevant things, but definitely we were not arguing over impractical, irrelevant things. We were just getting it done. From the funds, it was, hey, Chuck, should we reprice this? Um, I know that, I signed a term sheet at the end of February that said that we would give this valuation, but we're now, mid-March getting towards a close and it's a totally different universe, or late March, totally different universe. And, um, so we had this sprint to get deals done. And so I looked back at, okay, what are the 20 deals that we've closed since the start? And we got 10 of them done from mid-March to kind of getting close to the end of April. That's when they closed. And then there was a lull where I think the initial sprint had worn off and everyone was looking around thinking, well, shoot, what do we do? And also, generally speaking, if you were going to be closing deals from mid to late April through, call it late May, you would have had term sheets signed in March, maybe early April. And in my experience, almost no one was doing that. Uh, the as far as why, I think it's uncertainty. If you were a fund at that time and you've just closed the deals that you had in term sheet, whether you go sign more term sheets, you just kind of let the dust settle, right? And if you're a brand, same thing, because a lot of people are telling the brands, me included, hey, you gotta look at your valuation again, right? Like the universe is different. You may not get the valuation you would have gotten 12 months ago on the same statistics. But if you're an entrepreneur and that means more dilution for the same money, you're similarly going to let the dust settle and see if you really have to do that unless you're about to run out of cash. But by about the end of May, it picked back up radically. So we've closed 9 deals since the end of May, but those include some of our more substantial deals since the end of quarantine, very large venture rounds. By that I mean, 15 million and higher, um, and M&A deals. So M&A, slightly different from venture, was put on complete freeze, at least from my perspective, from early March on. And we didn't see any deals getting done. And we just closed one on Monday, and we have 2 more that are in market, and we expect we'll close, call it end of summer, early fall. So that has picked up meaningfully, including from the perspective of, are the strategics, which were frozen, now looking to buy again? And the perspective is yes. So that's kind of, if you think of it on a timeline, it was sprint, get deals done, complete lull, and now it's come back. Will it continue to come back? I have no idea, right? None of us have any idea what's going on. When you look around and you see the statistics, especially in the United States, around COVID, you have to ask yourself, why in the world has everything just come roaring back economically? At least, again, anecdotally, I don't know. There are a few things I would like people to take, though, that we've seen in action around how to approach a fundraising. The first is, are you raising from angels or funds? In other words, is it an early stage or are you doing your Series A, Series B? Here's why it matters. Angels don't have a committed pool of capital that definitely has to go to venture stage, CPG, ag tech, and food tech companies. Instead, they're generally rich individuals who can put their money anywhere. And in circumstances like this, one, they can just sit on their cash, which a lot of people are doing. And two, they can put their cash in any number of places which they view as opportunities. So you're competing against all of these opportunities for cash that doesn't have to be deployed. So angel money right now has been far more difficult for our brands than we've seen. And for background, we represent about 100 brands and a lot of the major funds in the space. So funds, however, have committed capital, most of which was committed before the pandemic. That means if a fund finds an investment, it can call on its limited partners who have to wire them the money for the investment. And think about the motivations for the people making those investment decisions at the funds. I'm sure you guys have heard the term carried interest. It basically means people who manage funds generally earn a piece of the profit they make investing other people's money. If they don't invest other people's money during this time period, they can't make carry. So they have every incentive to continue to invest the fund's resources in companies, and that's why we're still seeing a ton of venture rounds get done. Now, are they focusing on different things? Yes. First of all, they're increasingly focused, both at the angel and venture stage, on how scrappy are you? How far can you go with less money? I'll give you a anecdotal example that actually happened. We have one kind of mega angel. He's a super wealthy individual who invests all over this space. And the first question he has started asking founders is, what do you pay yourself? And this is real life. In one example, the founder said, I'm paying myself $40,000. He invested in that company. In another example, there were two founders, each of whom were paying themselves over $150,000. Now, these are both early stage companies, and who had 6 other people, so the total payroll was already over $1 million. So he walked from that opportunity because the perspective was you hadn't adjusted to the COVID reality. Slow your burn, focus on product gross margin if you're a CPG product, show me how much farther you can get on less money. So I have a lot more to talk about, but I'll kind of stop there. Maybe that's a good kickoff point for what we've been seeing.
Yeah, I think we're going to dig into definitely a lot more of that on the CPG side. Let's transition over to Poornima. I'm curious to hear your sort of firsthand experience of successfully fundraising right now, and especially not only on the startup side, but also really upstream on the ag tech side. So Poornima, over to you.
Yeah, happy to be here and to share a couple of learnings and a couple of observations with your viewership too. I'd say from our perspective, one of the number one things that worked in our favor was the problem that we're solving. The problem that we're solving is soil at Trace Genomics. It's all about soil. We're all about soil. Pre-pandemic, during the pandemic, post-pandemic, it's going to continue to be a resource that the entire world needs to care about. It's here to stay, and without soil, we're nothing. And so I think that focus in terms of understanding what is the data that we're generating from soil. It is a complex data set. How can we distill all of that information into insights? Is clearly a problem that resonates with the investment community. And when I talk about the investment community, the other thing that worked in our favor is we're really uniting investors from across the board. And whether investors are investing in sustainability-driven businesses, the problem that we're solving has a lot of implications for sustainable food systems, for a sustainable planet. There is a lot of tie into climate change in terms of the way in which we approach the world. The technology that we use can clearly unlock a lot of learnings based off of that relationship between soil and climate change. And then going all the way to the other side to, from consumers to the farm gate, farmers are working with soil. And so investors who are really interested in that land piece, who are interested in investing in inputs, in agricultural inputs, whether they're strategics or others, there's room for everyone to play. The problem really resonates with investors, even on that side of the spectrum. So that was definitely one thing that we saw resonate. And, to that, kind of following up on that comment too, we brought on board a couple of strategics. I think it's really important, even as we're a Series A stage company, and where we're seeing, just also given other founders in our space that I talk to regularly, other companies in a similar stage that we're at, we're starting to see a lot of success with companies bringing in strategics to the table at an earlier stage rather than at a later stage, and multiple strategics at that too, because strategics are invested in this problem. They're invested in solving it. They're invested in really moving towards more of a sustainable ecosystem from food to ag.
The other learning has been around really the types of investors that you bring to the table. Have they been investing in this space? Are they here to stay? Are they going to invest? If you're a seed stage company, are they going to invest in seed, Series A, Series B? Like, are they going to be with you through that whole process? Really look at your investors and bring people to the table who are here to stay, because they're the ones who also recognize that, look, pre-COVID, during COVID, post-COVID, this sector, food and ag, it's really important to invest in. They've been investing in it for a while. They're going to continue to invest in it. Where they place their bets might change, but they will continue to invest in that sector. So that was the other piece for us, that where we focused on bringing investors to the table who have been investing in the spaces that, both on the technology side as well as the market side, that our company touches on. The third piece of this is really, I think Chuck talked about this too, which is don't run from it. COVID is here, and how it's really important for companies to take it seriously, and to talk about how their business plans have changed, how their customer focus has changed or not, how they're going to be operating, both from a burn perspective as well as from a focus perspective. Pandemic is not the time to blitz scale for most of us. It's really about focusing and going deep and articulating how you are changing your strategy to stay ahead of the curve is really, really important. And investors are really looking for that. And we actually at Trace implemented shelter-in-place guidelines for our team. Our team health is number one priority. And we say that at every company meeting, every team meeting. It's always about keeping the team health at number one priority. And so we implemented shelter-in-place even 10 days before California did. And so I think really taking the world seriously, understanding and placing smart bets is critical for success, and investors are looking for that from a leadership perspective, also all the way into how the team is operating and team is running. The final piece is really about how do you build out talent at the leadership team level, as well as within the team for success in this new world and this new reality. It's all about munging expertise with entrepreneurship and a founding team. So what we did end of last year, was really bring on board a CEO who had decades of experience in the ag sector. And that's really helped on multiple fronts. Like, one, Dan's a great CEO. Two, I think it's also really catalyzed a change in the way in which investors perceive us, really this maturation process from a startup to more of a business that's humming, through bringing in experienced leadership and really building out that leadership team. We have continued to add on to our leadership team, bringing on board people with decades of experience in business on the operational front, et cetera. And that's, it's really important for our business, and that's why we did it. But it's obviously also a really great sign for investors who are looking for just growing the business in a very mindful manner, bringing on the right talent to be able to expand the business above and beyond what a small founding team can do. So I would say those are some of the key learnings for us.
Fantastic. Thank you, Poornima. I think there's a lot to dig into there. First, one of the things I was curious about, you mentioned how you were bringing in strategics at an earlier stage, and given that you're an ag tech focused company, Chuck, I'm wondering if you're seeing something similar on the CPG side, or if it tends to be later stage.
Yes, strategics. So not just recently because of COVID, right? Strategics in the CPG side have been getting involved earlier and earlier. It's sort of just a general trend. A lot of them have their own venture arms now. For example, one of the more well-known ones would be 301. That's General Mills' venture arm. They make investments early on. I think it's a mutual benefit. Of course, there are things you got to think about. If you're the brand, it's what rights am I giving the strategic? How much entanglement am I causing? Will I be able to unwind my business from them, et cetera? But on the other hand, you get, in theory, expertise from the strategic to help you grow your business, especially if you're reaching that point where historically the skill set that a founder has, which gets you to here, isn't always a one-to-one, Venn diagram of the skill set that gets you from here to here. But a good strategic relationship can help the founder carry it farther, right? Because they are in that later stage. It's good for the strategics because of the learnings that they can get around more nimble creativity and innovation, which at least on the CPG side, they struggle with significantly, right? If you're a brand manager and you've got a brand that does $1 billion a year in sales, you're just looking at what's going to move the needle 1 to 3%, right? And you don't really want to shake things up because if it falls 3 to 5%, you're in trouble. So it doesn't encourage innovative and nimble thinking, but working with the startups exposes them to that. And then the goal, the mutual goal, of course, without entanglement, if you're the brand, is that, as Poornima said, they'll invest at multiple stages and they are the natural acquirer, right? What you don't want to do if you're the brand is give them rights around acquisition, which effectively provide a ceiling to your acquisition value. But even if none of those rights exist, if it was a good relationship with the strategic, they should be the natural acquirer. Yes, we see it in CPG.
Mm-hmm. Cool. Thank you. Shifting gears a little bit. So Poornima, I think one of the things that your technology does and kind of focuses on is smart soil analytics and learnings. Do you think that you saw success through fundraising right now, despite the pandemic or because of the pandemic? Did that change anything for you in terms of success? And do you see innovations like those in ag tech continuing to see, what are those innovations that are continue to kind of be poised for success through what we're dealing with right now?
Yeah, just so I understand your question correctly, Jillian, are you talking more on the investment side or are you talking on the commercial side?
On the commercial side.
On the commercial side, all right. On the commercial side, I'd say, similar to a lot of companies in our space, our approach has needed to shift quite a bit. Well, I wouldn't say quite a bit. I'd say it's the way in which we view and evaluate risk has changed. And what I mean by that is when you look at soil and the people you serve, the end consumer of soil insights are typically the people who are working the lands, the farmers. And if you look at who's been impacted significantly by logistics and other systemic issues to the supply chain, it's the farmers. And they've been impacted in multiple ways. They were actually impacted even before COVID, right? But the tariffs, with weather and with a lot of other economic downturns, they have been significantly impacted now for a couple of years, and COVID's just another compounding factor for them to consider when they're making business decisions. For us, what that's meant is thinking about our customers and thinking about our product lines and business lines and actually having flexibility in terms of who we serve and how we serve them. So instead of only focusing on the grower as our customer, as the farmer as our customer, when we think about the soil insights and where they really provide value, they also provide a lot of value to, for example, distributors like retail input providers or service providers. And in a lot of ways, those relationships that the farmer has in times like COVID, they tend to rely on those relationships a lot more because those relationships are what they've always turned to for trust. And so we have also, in a lot of ways, aligned ourselves with the industry in terms of who is providing data, insights, supplies to the farmer. How can we help them do their job better so that farmers can continue to return a profit while relying on the relationships that they have trusted for generations? So I'd say that's been, for us, one of the shifts is really going more input provider, service provider, data provider, really shining the light on that customer segment. We are obviously continuing to service the farmer through all of this, and large producers are still continuing to do business with us because large producers are still continuing to invest a lot in technology and innovations and science-driven insights. What we're seeing too is a little bit of a pullback from farmers in terms of investing in new technologies and rather focusing on bolstering some of their investment on existing processes or machineries on the farm. So that was the other, I'd say, shift that we're seeing. There's this, bolstering existing relationships, bolstering investments into existing assets. And that's also worked in our favor because land is their number one business asset, and soil and land and how do you manage that will continue to be top of mind for them through the pandemic.
Fascinating. Thank you. I think that's really interesting. And as we're thinking about sort of how that affects downstream, Chuck, I know we touched briefly on this when we were talking earlier, but sustainability, I think, continues to be sort of a key metric for success, especially through the uncertainty of something like this. What else are you seeing in terms of successful startups that have come through and who are fundraising right now?
Sure. I think one thing that's definitely worth mentioning, given the incredibly talented co-panelist I have, is that there's not a bright line between CPG and ag tech, for example. I'll give an example of a brand we work with. They're called Sunday, and they use soil data and climate data to help you pick the best all natural, kind of better for the earth lawn care product online. So it's customized for your soil, your climate, your lawn. It's more sustainable, better for the environment, ingredients, and they're kicking ass, right? When it comes to sustainability in the CPG space in general, which, correct me if I'm wrong, I think is what you're getting to, is how much we're seeing that. It's a factor, but when it comes to CPG, sustainability is something customers want, and since customers want it, venture funds want to invest in brands that are providing it. But it's not a substitute for the other things that still matter for consumer products. Brand. If you're a food and beverage product, taste, right? And price point. So I would say if maybe previously, and maybe some CPG veterans would add some more categories, you were generally only focusing on brand, taste, price point, and then all of that supported by marketing, how quickly you can get a product moved off shelf. There's now a fifth tentpole over the last few years, which is sustainability. People do genuinely care about the impact of the product they're consuming on the environment. And that's just the new reality. Mm-hmm. So we see it across the board in CPG.
Yep. Cool. Okay, I'm going to switch gears a little bit again too. Now, I know you said you can't really forecast what's to come, Chuck, but I'd love to hear from both of you, just anecdotally, what are we looking at for 2020 and beyond, and what do you think we're going to start seeing with the investing landscape?
I'd say one of the trends that we're seeing quite a bit is this continued investment in science and technology. I don't think that's really going to go away. If anything, science and technology are going to fuel a lot of innovations that will help solve some of these systemic and logistics issues that we're seeing across the supply chain. Science and technology will also, in a lot of ways, when we think about especially all of these rankings that you have, right? Like, who are the top 10 companies? Who are like the top 20 companies in your space? What is number 21 doing? Investing in science and technology so that they can get into the top 20, right? And so there is still, there's a lot of room there, and that's what we're seeing is that science and technology investments, especially biotech, right? Like vaccines and COVID. I mean, that's a no-brainer, for example. But it's similar to science and technology that are fueling vaccines. Those have applications in food and ag too. When you think about genomics, like what we're doing, like I can just use us as an example. Genomics changed up the way in which human personalized medicine is being done today. it's that same technology that we're taking and applying to food and ag. And so you're going to start to see a lot of those migrations or opportunity creations for science and technology across different sectors, and we're already seeing that. Alternative protein is another great example of that in terms of science and technology that originated in labs for human, really moving more into that food space and kind of tying that in, really that food health benefit piece, like alternative protein, but also what you eat, where it comes from, where it originates from, how does that tie into your health and the health of the planet? I think that is going to really, there's a lot in that space that we're starting to see both science and technology move into solving some of those issues, as well as policy in general, where there's initiatives that are happening at the governmental level or even across different stakeholders from industry, and there's funding that's going towards those initiatives. There's nonprofits too that are driving some of those initiatives. The other places where I'm starting to see innovation being funded is in the indoor ag, digital ag spaces. For example, when you look at the supply chain being broken, how do you reinvent the food from where food is produced, and how can we bring food to market sooner? Some of our own farmers that we're servicing are actually diversifying their portfolios. They're growing different types of crops. They're thinking of different ways to get their produce to market using different online marketplaces. I thought it was really neat how some farmers are already starting to sell their produce, not even to retail or restaurants, because you're seeing that shift from restaurant to retail too, right? Like, so that's where the online marketplace can help quite a bit in terms of helping farmers sell their produce. But there's this other piece where farmers are like, you know what, I'm just going to sell directly to the consumer. And you're starting to see a lot of entrepreneurship there too, where farmers are testing out different ways to sell produce. And that is also fueling a lot of innovation in that. How do you get food from the farm to your end consumer as well? And then the final piece there too is around inputs. There is a broken chain, we are going to see also this being compounded. When you think about where fertilizers come from, where pesticides come from, for example, the chemicals are being mined across the world, like around the world. And now with COVID disrupting a lot of the international trade relations, as well as international just a movement of supplies around the world, there is more of a focus on national supply, domestic supply. I think you're going to start to see innovations really help us meet our domestic needs at a more at a domestic level, rather than trying to go and source supply from international from global areas around the world. So there's going to be some innovation in that space, and you're already starting to see funding going towards companies that are enabling that.
If I were a perfect forecaster, I'd be rich and wouldn't be a lawyer. But I suspect, so historically, food and beverage and consumer products, as long as it's not on the luxury end, have been very recession resilient. That's historically. And then when you apply the specific factors around what's happening right now, it should make you think CPG is going to be even more resilient, because people are consuming food and beverages at home far more than they are in food service. So unfortunately, food service and restaurants and hotels and so on will not be resilient, but that's not really what we're covering. So I expect, actually, when you combine that with what I mentioned before about this just sort of enormous pool of committed capital that already exists in the space, I think that the venture activity will be very robust. The M&A activity is a little more uncertain because we have to see how the strategics behave, but the private equity funds, I believe, will still be acquiring good companies. That's not to say it's going to be business as usual. I don't think it will be. I think, I've described these venture funds as, I've got this committed pool of capital, I'm going to invest it because that's how I make my carry. But these are not purely self-interested or stupid people. These are very smart people. That's why they're running venture funds. And they're going to be looking for effectively a valuation reset, because it has certainly been the perspective pre-COVID that the CPG valuations were a little bit run amok over the last 3, 4, 5 years as compared to underlying business fundamentals. So despite fundraising activity being robust in my forecast, I think valuations will be reset a little bit. I think they'll be down. And I think most investments will be slightly larger and later stage because the investors are going to want to see some companies break out from the noise. They're going to want to see proof of concept through COVID. How have you reacted? And I think there's unfortunately going to be a bit of a graveyard of early stage companies who either built underlying economics for their products that just don't work unless you can raise a ton of capital and be on this cycle, or they didn't pivot in quarantine quickly enough. An example being, if you're a new consumer product that sells at retail, you generally thrive on trial, right? You have to get people to try your product in order to buy it. Well, with so many fewer people going to grocery stores in person, how are you going to drive trial? You better have an answer for that. You better implement that answer, and that answer better be successful before you think you're going to get a venture investment.
Yeah, a lot of fast pivoting there, and I think the silver lining that both you and Poornima kind of touched on is, with food and ag, this is something that is going to continue to see investment and innovation. So before we head it off to Nina for Q&A, do either of you have some final sort of advice that you can share with startups tuned in right now who are in this stage?
I think my advice would be, take the pandemic seriously. There's a lot of lessons learned here, and just be ready to articulate how your plans have shifted, will shift, to make sure that you continue to stay in business during and after the pandemic. There's a lot of uncertainty that COVID has really tossed out of the world, and nobody has all the answers, but that's why it's really important more than ever to make smart bets, right? So I'd say make sure that you can articulate what your risk mitigation strategy is, how you're reducing burn, and how you are focusing on executing and focusing your customer base to really deliver success to your customer. I think that's something that investors are going to look for no matter what.
Cool. Thank you, Poornima.
So that was an awesome answer. So I don't have a lot to add. Maybe think about changes in long-term consumer behavior, and does your product address those in any way? Clearly, for a lot of products, the answer is going to be it doesn't. If your product is one where a long-term change in consumer behavior is going to affect your product negatively, be able to address that. But for a lot of products, people aren't going to all of a sudden go back to pre-COVID consumption of things like immunity boosting foods, hand sanitizers. These are things that long-term, even after we potentially have a vaccine, people are going to be in a habit of consuming more. So think about how you can take advantage of it if you are a company that falls into that category.
Cool. Thank you, Chuck. That's great. All right, I'm going to go ahead and pass it off to Nina, who's going to kick us off with some Q&A. Looks like we've gotten a few in, and just another reminder to keep funneling any questions you have for our speakers into the Q&A. So Nina, over to you.
Great, thank you. Yeah, hi everybody. Thanks so much for these really salient insights so far, Chuck and Poornima, and sort of tangible examples of what you're seeing from your pretty distinctive positions. There's a lot where we're trying to cover the entire value chain here to some extent, an entrepreneur perspective and sort of a lawyer representation perspective. So I want to, again, there's a couple of questions that have come in, which I would like to get to in a moment. But I think we'll start with a couple of questions for Chuck, a few for Poornima, and both, and bounce around as necessary. So yeah, Chuck, I think you just pointed to something pretty interesting in your last piece of the question around how entrepreneurs can sort of drive trial, and really how they can, CPG entrepreneurs, how they can effectively prove that they've pivoted. Most likely that's on the e-commerce front. So I wanted to see if, even if you can't share company names, now that we're 3 to 4 months into this pandemic, nearly 5 actually. If you can share some examples of startups either that you've seen or in your network that have really successfully pivoted to e-commerce and sort of shown shown positive metrics there and been able to stay resilient, get out of survival mode, raise capital, for example. I think it'd be great to just hear either 1 or 2 tangibles that you can share on that front.
Maybe I'll think and come up with a better answer, and I'll just add it on to a different question later on, because
Okay.
because the general answer is unfortunately not that helpful, which is the companies that have been best about attracting attention through even things like online ads, Facebook ads, Instagram ads, etc., have been the ones that have been the most successful. And I think that's probably so obvious you didn't need me to say it, but it's what we've seen is the people who can acquire customers through fun ads that can demonstrate to someone who can't actually taste the product that they really want to taste the product. They've been most successful. There are folks tinkering with other ideas about how to drive trial in the idea that we're all remote, but I haven't seen a ton of those actually implemented. I think I saw a statistic which said something like, don't take view this as directional and not exact. Pre-COVID, maybe 4% of groceries were ordered online, and I think by mid-April it was over 40%. So that's a massive change in consumer behavior that people are trying to address. I'll try to come up with a more specific answer for you, Nina.
Yeah, no worries. Didn't mean to put you on the spot. We've seen a lot of entrepreneurs in our ecosystem, like sort of making steps to either completely revamp their websites, make a more robust relationship with Amazon, and we've seen that that's become the main focus. And I think if you think of more examples where it's been like a clear slam dunk, I think that continues. That would be helpful for our audience. But I think I'll move through to a question to Poornima, and we'll sort of bounce around because I think you mentioned something really interesting regarding sort of changing your customer focus slightly through COVID and kind of sort of diversifying there beyond just the growers. I'm curious for ag tech folks that we have on the line, what data points are you seeing that growers are increasingly relying on to help them sort of operationally during COVID? You're obviously very, very close to the farmers, producers, and growers. So what you can share, I think would be really helpful to understand kind of what are those data points that maybe are having more, there's more stress on right now from the grower side.
A couple of observations, growers are still relying on weather and the price of inputs and the grain markets or their produce prices, right? There's still that price-based decision-making framework that has not shifted or will not shift. It's all about making profit at the end of the day. What is different is that in addition to those, now they have to stay on top of what is happening in their community. Both, when I say community, they're service providers, as well as if they need to take hogs to market, has to go through a processor. And all of these processing plants are grappling with COVID. You're seeing processors close down, huge processors close down. And that has created a lot of ramifications in terms of both stresses on production facilities that are being run by growers. When we say growers, a lot of them have animals as well as they grow crops, right? And so you're starting to see that stress of processor closures really impacting growers because they have to hold on to their hogs longer, they have to feed them longer, and by that time it's really too late to move them to market, so on and so forth. And so they are incurring heavy losses on the meat side. Grain market perspective, the tariffs are still have had a huge impact on growers from last year continuing to this year. And the pandemic is not making things any easier in terms of our growers being able to sell into international markets, for example. It's slowed. And so that's also resulted in severe stress to the grower. First of all, they have silos full of grain that they haven't sold from last year, and now they're going into this year's crop. They're going to create more grain. Where is that grain going to go? So there is going to be a stress even on the storage mechanisms for grain and for produce. We've also seen a lot of our customers, the growers, have been, for lack of labor, for lack of demand from restaurants, because a lot of times the produce that growers grow, like for example leafy greens, there are different varieties for restaurants versus retail. And when restaurants have gone down, where do they sell? Like, what does that supply chain look like? What does that marketplace look like? And it's created a lot of losses for growers because, one, they don't have labor. There's labor shortage because people are afraid to show up at work with COVID going on. And on top of that, like, labor's always been shortage in places like California. So you're starting to see existing problems being amplified in COVID and new problems showing up because of the shift from restaurant to retail. I'd say, the silver lining is, yes, there are some types of crops that you are starting that have shown an increase in demand. These are typically shelf-stable crops or shelf-stable produce, and so growers who are growing shelf-stable produce typically have seen higher profits, greater demands.
So thank you so much for providing so much more sort of analysis there. And I think there's a question that ties into the points you just touched on that just came in through the Q&A, which is, do you see regulators, taking a stand, potentially helping accelerate biotech-related technology adoption by farmers? I think you spoke to this in the earlier part of the presentation. The next part of this question is, like, potentially, penalizing those who don't adopt or rewarding those who do. Is that something that you see transpiring in the near to mid future?
Yeah, I think as different levels of society, we all have the responsibility to not make things even harder for ourselves or for our farmers or for consumers, for anyone in this world, actually. And what I mean, it's a new reality, right? And everyone's trying to grapple with it. And what I'm trying to say is we're probably going to anticipate to see regulations helping rather than hindering the adoption of new technologies. You're already seeing that, for example, with vaccines for COVID. You're starting to see an acceleration towards market, towards availability to the general population. And we're probably going to start to see something similar with technologies which have generally the consumers have been averse to. There might be exceptions that are provided by regulators to adoption of some of those technologies to ease the stress that we're seeing on the food supply chain, to ease some of the stress that we're seeing in terms of just keeping farming going as a business, like as a viable business. Nobody knows like what farming's going to look like, what the business of growing food is going to look like, and how it's going to change. So I'd say from a regulator perspective, what we're anticipating is perhaps an easing of regulations to really help us meet some of these demands that COVID has thrown at us. I'd also say in general, given the advancements that science and technology have made in providing vaccines, diagnostics, et cetera, the population in general is more aware of what science and technology can do for us in this age of COVID. I also think that heightened awareness is going to really help with easing some of these regulations in terms of allowing for science and technology to create more of a direct impact in the real world rather than languishing in an office somewhere paperwork. So, yeah.
Thank you. And I think that this is a bit of a dichotomy leading into the next question with what you just sort of spoke to in terms of, less stringent regulation leading to potentially more and very necessary innovation upstream. But Chuck, I think I'll sort of punt this one over to you. There's a question, obviously, on the downstream consumer side. We talked about this a lot on our previous fundraising webinars, but the comment is, as the pandemic continues and we live much more isolated lives, we have seen consumers kind of sticking with older, tried and true products. We saw, obviously, a couple months into the pandemic, there were, sales growth with old CPG products from sort of legacy brands. The question is, do you think that this in general will continue and potentially would have an effect on there being less innovation in the CPG category? Or do you disagree with that and think that we're coming out on a different side of that coin?
Yeah, so I won't dodge answering, but the answer to that question is not something like asking me about venture investing where I can give you an answer. That is correct. This is just a speculation. So that the statistics are accurate that people were doing that, in the first few months. I don't know if they still are, but I think it's psychological rather than a long-term consumer behavior change. I still believe the arc of long-term consumer behavior is still towards better for you, transparent, sustainable, that can also meet taste and price point. And a lot of these legacy products only hit taste and price point. So I personally do not believe that that's a trend that's going to continue. To reverse it, you are, of course, running into the issue of driving trial, right? So if there's an area of innovation in CPG that I think is most ripe over the next 6 to 12 months, that is not product specific, it will be, can someone build a tool or an approach to drive trial physical consumer products, right? That I see as the issue stifling innovation, so to speak, is just driving trial of these new innovative products. I don't think it's because customers are going to revert their long-term behavior towards these legacy products. I could be wrong, but I just don't think consumers want those products other than in a psychological comfort needing stage.
Yeah. Yeah, that makes a lot of sense. And we're seeing interesting things in sort of the startups that are initially applying to pitch for FoodBytes and the application data that we've been looking at so far. I mean, functional food is still the top CPG category, and now there's a real strong focus around wellness, for example. So the category is remaining strong in the applications that we're seeing across the CPG space. The focus has shifted a little bit to the point you all have made earlier on this webinar, to be really relevant to COVID and to what consumers are experiencing. So one quick question there, and then we have 4 more minutes. So we have like basically 2.5 more minutes for Q&A. It's really quick, Chuck. The question was like, do you have any high level ideas on a startup that believes they're really reliant on tasting of products? That's a part of their pitch. This person has said it's a refrigerated product, can't make a flight. Obviously, face-to-face is totally not possible right now. What's your advice?
Keep hitting the one that's impossible, right? Which is where I think someone's going to make a lot of money coming up with a way to drive trial. You got to be innovative online. It's marketing, right? Because people have floated the idea of just allowing people to sign up for receiving a free product and you ship it to them, right? There are other ideas adjacent to that I think could work. But right now, unless you have an incredibly expensive product and you have a level of certainty about reorder, the idea of just shipping people free product around the country is not efficient. So I think it just comes down to your marketing online and whether you can convince people who can't taste the product that if they only could, they would know how amazing it is, right? That's the task before them. By the way,
Yeah.
I should put a shout out to one FoodBytes company that is definitely thriving through this, who still has to drive some trial, but had reached at least a critical mass where that wasn't a threshold issue. But you probably know Vive Organic, right? When we're talking about,
Yep.
companies that fit not just the short-term changes in consumer trends, but long-term and being able to capitalize on it. People who are not familiar with that company should look them up. They're killing it.
And last question, this is a large question and it deserves much more time, but this has gone pretty quickly. But I want to tie into the theme of our last webinar around kind of the fight for racial justice in the food and ag industry. So this is for both of you to answer, ideally in 30 seconds or less. But I just wanted to get your thoughts on if societal pressure that we're seeing right now to make the investment landscape more diverse and inclusive in food and agriculture. Do you see there being a push and a meaningful, lasting change taking place in terms of how investment dollars go into food and agriculture, in terms of BIPOC founded companies, female founded companies? Any last minute thoughts that either of you want to share on that front?
Yes, the short answer is yes. We're seeing a push in the right direction. I'd say when I talk to fellow executives, founders, small, large companies, some of my mentors, really that sustainability of this shift has to come from inside. So how are you building mechanisms, processes, teams internally to sustain this shift and this investment while maintaining balance of voices, so not going too much to one side or the other. I think that's going to be an ongoing work for all of us here.
And Chuck, any thoughts from you, as you represent a lot of female founders, I know?
Yeah, so I would say first of all, everyone needs to take the responsibility to improve at every aspect of this, right? You could say, people need to invest more in women entrepreneurs and people of color entrepreneurs, but that'll happen more often if the funds themselves have more women and people of color making those decisions, for example, and if law firms do the same. I would say that if there's a wave in CPG of improvement, women were at the front of it, and it's still not where it should be, but it is, even from my just anecdotal perspective, even farther off from where it should be in people of color receiving investments from these funds. And I think the smarter funds are going to look at that as a business opportunity, right? That means there are a lot of amazing investments to be made in the underinvested entrepreneurs.
Yep.
But I think there's still a lot of work to be done, despite all the focus on it recently. It's going to take a long time, a lot of work, and everyone needs to be committed to it.
Fantastic. Well, there's always more to dive in on there. I just wanted to end on that note. I will hand it over to Jillian to close us out now that we are at the 1 hour, which this has gone very quickly. So over to you, Jillian.
Thank you. And thanks to everyone who tuned in, and especially a huge thank you to both Chuck and Poornima. Your insights were incredibly valuable, and we're really happy to have you on the show today. A recap and recording of the webinar will be available on our website at foodbytesworld.com as of Friday. So if you want to catch up on that, please do. And a final note that we will be having another webinar on July 29th. This will be the final one in our summer series. So stay tuned for more information on our social media channels to register. Thanks again, and we'll see you next time.